The Monetary Policy Committee met on the 26th and 27th of July 2021, faced with cautious optimism for the recovery of both the global economy and the domestic economy. The performance of the global economy in the first 2 quarters of the year had been favorable and is expected to continue for the rest of the year. There is, however, renewed downside risk to this optimism associated with the fast spread of new and deadlier strains of COVID-19 virus. The high rate of vaccination across the globe seems promising to drive herd immunity to reduce mortality rates. In the domestic economy, the continued support by both the monetary and fiscal authorities is expected to yield favorable outcomes and hopefully return the economy to a strong recovery path in the next few quarters. The committee reviewed the developments in the global and domestic economic and financial environments during the second quarter of 2021 and the outlook for the rest of the year. 9 members of the committee were in attendance at this meeting, the Global Economic Development. Committee noted that while there has been reasonable gains in subduing the pandemic, lowering of restrictions and reopening of several economies, the fast pace of mutation of new and deadlier strains of the virus is posing a downside risk to the full recovery of the global economy. In addition, the uneven access of vaccines across several countries is a significant risk to the attainment of global herd immunity. Despite the above challenges, governments all over the world have continued to ease restrictions to enable the recovery of supply chain networks and enhance aggregate demand. The expected rebound in global output growth is dependent, therefore, on the efficient development of COVID-19 vaccines, with the expectations that the evolving deadlier strains will be subdued. Even with the current outlook, the IMF projects global growth at 6% in 2021 compared with the last projection of 5.5%. In line with this, the advanced economies are projected to grow at 5.1%, while the emerging markets and developing economies are projected to grow at 6.7%. Price development across several economies is expected to remain moderate in the short to medium term, with some prospects of a mild uptick. The committee further noted the rise in inflation above the long-run objectives of some key advanced economies, although reported as transient and therefore not expected to lead to an adjustment of the stance of monetary policy. There, however, remains the lingering risk of an early return to monetary policy normalization should price development continue to trend upwards. Across several emerging markets and developing economies, inflationary trend was on average mixed, with some of the economies recording significantly higher risks compared with their peers. This was largely due to exchange rate pressures, capital flow reversals, high energy costs, weak supply chains, and poor response to policy stimulus to combat the macroeconomic slowdown associated with this pandemic. In the global financial markets, committee noted the increased demand for equities securities, an indication of improved investor confidence in the global recovery. In addition, it observed the progressive weakening of long-term sovereign bond yields as the demand for equities pick up. The MPC further noted the moderation in the price of gold, signaling reduced demand as investors return to the financial markets. The unprecedented stimulus provided by monetary and fiscal authorities to ease the impact of the pandemic has, however, heightened the risks of global financial crisis post-pandemic and calls for central banks across the globe to remain vigilant should the need for sudden policy adjustments arise. Domestic developments. Real gross domestic product GDP grew at 0.51% during the first quarter of 2021 compared with 0.11% during the preceding quarter. In the non-oil sector, agriculture and industry subsectors were the major drivers of growth, with growth rates of 2.28 and 0.94% respectively. The oil sector year-on-year contracted by 2.21% during the first quarter of 2021 compared with minus 19.76% in the previous quarter. The weak performance in the oil sector is attributable to several factors, including the declining quality of oil infrastructure, lack of new investments in the sector, and the need to comply with the OPEC Plus production quota. The committee noted that the Manufacturing Purchasing Managers Index, PMI, improved to 46.6% index points in July 2021 compared with 45.5 index points in June 2021. Though it remained below the 50% index point mark, the improvement is an indication of gradual recovery of output growth in our economy. The non-manufacturing purchasing managers index PMI also increased to 44.8 index points in July 2021 compared to 43.0 index points in June 2021. The employment level index for July 2021 stood at 46.5 index points relative to the preceding month figure of 45.0, but remained below the 50.0 index point threshold. The committee welcomed the sustained monetary and fiscal stimulus to revamp the domestic economy and hoped that the distribution of vaccines to subdue the pandemic will continue unabated. Committee noted the continued moderation in headline inflation year-on-year to 17.75% in June 2021 from 17.93% in May, the third consecutive month of this decline. The decrease was attributed to a marginal decline in both the food and core components to 21.72 and 13.09% in June 2021 from 22.28 and 13.15% in May 2021, respectively. The MPC noted that though headline inflation remained well above the ceiling of the central bank's 6 to 9% corridor, it expressed optimism that the current interventions by the CBN in various sectors of the economy will further depress inflationary pressure as output growth improves and the negative output gap closes. On the performance of the monetary aggregates, the committee noted that broad money supply M3 declined to 2.02% in June 2021 compared with 2.99% in May 2021. This development was largely driven by a slowdown in the growth rate of net domestic assets NDA and net foreign assets NFA. Net foreign assets contracted by 3.65% due to the contraction of the foreign assets holdings of the central bank, as well as non-interest, primary mortgage, and microfinance banks. The marginal decline in net domestic assets (NDA) reflected the slowdown in aggregate credit net, which decreased to 4.3% in June 2021 from 4.79% in May 2021. Accordingly, aggregate credit at the end of May 2021 stood at 24.23 trillion naira compared to 22.68 trillion naira at the end of December 2020. This represents year-to-date increase of 1.55 trillion naira. Under the bank's development finance initiatives, the bank granted 756.51 billion to 3,734,938 smallholder farmers cultivating 4.6 million hectares of land, of which 120.24 billion naira was extended for the 2021 wet season to 627.51 farmers for 847,848 hectares of land under the Anchor Borers program. For the agribusiness and small and medium enterprise AXMEs, the sum of 121.57 billion naira was disbursed to 32,617 beneficiaries, and for the targeted credit facility, 318.17 billion naira was released to 679,422 beneficiaries, comprising 572,189 households and 107,233 small and medium scale enterprises. Under the National Youth Investment Fund, the bank released 3 billion naira to 7,057 beneficiaries, of which 4,411 were individuals and 2,646 to small and medium enterprises. Under the Creative Industry Financing Initiative, 3.22 billion naira has so far been disbursed to 356 beneficiaries across movie production, movie distribution, software development, fashion, and IT verticals. Under our 1 trillion naira real sector facility, the bank has so far disbursed 923.41 billion naira to 251 real sector projects, of which 87 were in light manufacturing, 40 in agro-based industry, 32 in services, and 11 in mining. As regards the 100 billion naira healthcare sector intervention facility, so far we have disbursed 98.41 billion naira to 103 healthcare projects, of which 26 are pharmaceutical companies and 77 hospital services. Similarly, the sum of 232.54 billion naira has been disbursed to 5 beneficiaries under the CBN's Healthcare Sector Research and Development Intervention Scheme for the development of testing kits and devices for COVID-19 and Lassa fever. As regards the National Mass Metering Program, 36.04 billion naira has been disbursed to 17 meter asset providers under 9 discos for the procurement and the installation of 657,562 electricity meters. As regards the Nigeria Electricity Market Stabilization Facility NEMS 2, CBN has released 120.29 billion naira to 11 discos to provide liquidity support and stimulate critical infrastructure investments needed to improve service delivery and collection efficiency. On money market development, the net liquidity position and interest rates in the economy reflected the impact of the bank's liquidity management operations. Accordingly, the monthly weighted average interbank call and open buyback rates rose to 16.87 and 16.39% in June 2021 from 15.95 and 16.16% in May 2021, respectively. Committee noted the weak performance of the equities market despite the recent increasing patronage by domestic investors. The all-share index decreased by 1.28% to 37,947.18 on July 16, 2021, from 38,437.88 on May 31, 2021. Similarly, market capitalization decreased by 1.3% to 19.77 trillion naira on July 16, 2021, from 20.03 trillion naira on May 31, 2021. The MPC noted that Capital adequacy ratio and liquidity ratio both remained above the prudential limits at 15.55 and 41.3% respectively. The non-performing loans ratio (NPL) at 5.7% in June 2021 showed progressive improvement compared with 6.4% in June 2020. The committee, however, urged the bank to sustain its tight prudential regime to bring non-performing loans below the 5% regulatory benchmark. Committee noted the marginal increase in the external reserves, which rose to $33.8 billion on July 22, 2021, from $32.78 billion as of June 2021. Our outlook. The overall outlook for both the global and domestic economies remain clouded with downside risks despite the upbeat forecast for a speedy recovery. These risks include lingering uncertainties surrounding the path to the termination of the pandemic as new and deadlier strains of the virus continue to pose a significant threat to the efficacy of the COVID-19 vaccines. In addition, the uneven distribution of vaccines across the globe is undermining the realization of the current forecast. Capital flows to emerging market economies remain uncertain as the pace of price development in the advanced economies pick up, while the US Fed and other major central banks have given indications that the current rise in inflation is transitory and may not require policy adjustments. Inflation is confronted with a significant upside risk. This may result in an early return to monetary policy normalization with adverse consequences for financial system stability. Available data and forecasts for key macroeconomic variables for the Nigerian economy suggest a broad improvement for the rest of the year. This is hinged on continued progress with the containment of the pandemic as well as ongoing monetary and fiscal support. As a result, the Nigerian economy is forecast to grow in 2021 by 3.45%, CBN estimate, 3%, Federal Government of Nigeria estimate, and 2.5% IMF estimate. Committee's consideration. The committee noted the gradual recovery in output growth following positive growth in the first quarter and improving PMI in subsequent months, expressing confidence that the second quarter output result will show further improvement. The MPC carefully assessed the options confronting it in the short to medium term, analyzing downside risks to growth and upside risks to inflation. It commended the continued effort by both the monetary and fiscal authorities as well as public health agencies in stemming the pandemic and its impact, thus returning the economy to a path of recovery. While the economy has been gradually reopening, members noted that the pandemic was far from over and therefore continued to hinder the recovery. It thus urged the Presidential Task Force on COVID-19 to intensify efforts towards the procurement of more vaccines to ensure that herd immunity is achieved in Nigeria. MPC was concerned about the broad level of insecurity across the country, noting its impact on business confidence and overall economic activities. It noted the persistent insecurity in key commodity-producing areas and urged the federal government to intensify security surveillance in farming communities to ensure an uninterrupted farming activity. Committee members expressed optimism about the moderating impact of the forthcoming harvests on food prices, as this would contribute to the ongoing broad reduction in headline inflation. The CBN will continue to release maize from its strategic maize reserve directly to feed millers as part of its strategic response to address rising food prices and moderate the price of maize across the the country. Members further noted the contribution of poor infrastructure to rising domestic price levels, reiterating their call to the federal government to prioritize investment in public infrastructure such as improved transportation networks, power supply, and telecommunication facilities. Funding for such projects, the committee noted, could be sourced through public-private partnership as well as the issuance of diaspora bonds. It emphasized the complementary role these bonds will play to boost foreign exchange supply, improving accretion to reserves, and easing the exchange rate pressure. Notwithstanding the moderate decline in market indices, the committee noted that the equities market remained in a good place, indicating sustained investor confidence in the Nigerian economy. MPC applauded the continued resilience of the banking system in the face of severe shocks to both the domestic and economy. Members noted management's effort in maintaining a reasonably low level of non-performing loans ratio, even though aggregate credit moderated slightly. The committee encourages money banks to consumers and firms to enhance consumption and production activities necessary to strengthen our recovery. The committee members noted the persistent reduction in remittance of oil revenue to the Consolidated Revenue Fund, stemming largely from rising levels of cost under recovery and other obligations, particularly to joint venture contracts. The committee thus urged the government to continue to explore additional sources of non-oil revenues, as this would reduce the overdependence on a single revenue source. Members applauded the efforts by the federal government to encourage the use of gas in motor vehicles and the payment for conversion of 1 million premium motor spirit petrol PMS driven vehicles to gas driven to reduce overall cost of PMS consumption. The committee encouraged the participation of private sector initiatives to develop and expand modular refineries, while it frowns at cross-border smuggling of PMS. The committee also noted the increased contribution of the non-oil sector to government revenue in recent times, which reflected the gradual diversification of the Nigerian economy and reduced reliance on crude oil export proceeds, and calling for increased support for the non-oil sector in the country. Overall, members were confident that the bank was taking the right steps towards the restoration of macroeconomic stability, while noting the downside risks to growth and the upside risks to price movements. Committee's decision. At this meeting, the MPC was delighted that inflation had begun to trend downwards, while output growth had remained positive. Committee, however, was of the opinion that there was a need to continue to put in place policy measures that will further and faster drive down inflation, while at the same time accelerate output growth to levels above population growth rate. Whereas the arsenal at its disposal had almost become fully exhausted, MPC believed that there is the need to continue to use those tools that had been adopted so far, even in a more aggressive manner. MPC therefore encourages the bank to continue to use its existing administrative methods to rein in inflation by the use of its discretionary CRR policy to mop up liquidity from the banking system as the need arises. Committee also encouraged the bank to continue the use of its intervention mechanisms to deploy funds to output-stimulating and employment-generating sectors of the economy, such as the Targeted Credit Facility, the AXMIS, agriculture, and manufacturing sector. In the committee's view, the current situation neither gives room for tightening, as this will halt output growth, nor loosening, as this will exacerbate inflationary pressure. On tightening, MPC feels that whereas this will limit excess liquidity available to attack the foreign exchange market, it nevertheless feels that tightening will reduce money supply and thus inhibit the ability of deposit money banks to create credit that is needed to stimulate manufacturing output, which could also help to moderate prices. On loosening, whereas MPC feels this should transmit into market interest rates, which could improve the ability of obligors to repay their loans and reduce NPLs. It nevertheless feels loosening would not only exacerbate inflationary pressures, but this would increase negative real interest rate of return and discourage investments in the domestic economy. Based on the above considerations, the MPC made the decision to hold all parameters constant, believing that a hold stance will enable the continued permeation of current policy measures in supporting the recorded growth recovery and macroeconomic stability. The committee thus decided by a unanimous vote to retain monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain MPR at 11.5%, 2. Retain asymmetric corridor at plus 100 and minus 700 basis points around the MPR, 3. Retain the CRR at 27.5%, and 4. Retain the liquidity ratio at 30%. I'll now switch over to the second aspect, which had to do with recent developments in the foreign exchange market. Distinguished members of the press, ladies and gentlemen, in continuation of the press briefings for the July 2021 MPC meetings, I'd like to provide some updates and policy decisions regarding the operations of some aspects of our foreign exchange market in Nigeria. As we all know by now, Nigeria has been dealing with the effects of three significant and simultaneous global shocks which began around the first quarter of the year. First, there was the onset of COVID-19 pandemic, which claimed millions of lives, destroyed billions of livelihoods, and continues to have a devastating effect on current global economic activities. Second, given the sharp deceleration and complete stoppage in global economic activities at some point, we also witnessed a protracted and steep decline in the price of crude oil, which contributed to the largest share of our foreign exchange reserves. Indeed, as of 20th April 2020, the price of crude oil fell below $0 per barrel as producers were forced to pay buyers for overwhelmed storage facilities. Third, given that no one knew the depth or duration of the pandemic, many foreign investors withdrew massive amounts of funds from the emerging market economies, including Nigeria, and reinvested them into safe haven assets like the US Treasuries. The Institute of International Finance estimated that investors withdrew over $100 billion in emerging market portfolio equity and roughly $20 billion in emerging market portfolio bonds in the wave of the pandemic. Nigeria suffered its share of these withdrawals during that time, although we are beginning to see some of these investors return back to Nigeria. In the aftermath of these shocks, we saw daily turnover in our foreign exchange market fall from almost $300 million per day in the first quarter of 2020 to about $40 million per day at the height of the pandemic. In light of various efforts and initiatives by the CBN, we have seen this number rise to as high as $150 million per day in July 2020. Despite the aforementioned FX supply pressures, the demand for foreign exchange has not abated, thereby putting additional pressure on our reserves. To avoid further depletion of the reserves, the CBN took several countervailing actions, including prioritization for imports of critical raw materials and providing ample supply for businesses and personal travelers. While these have been turbulent times, we are happy to note that these measures have been positively decisive in helping us maintain a healthy level of reserves despite these exogenous difficulties. In total disregard of the difficulties that the bank is facing in meeting its mandate of maintaining the country's foreign exchange reserves to safeguard the value of the naira, we have continued to observe that stakeholders in some of the subsectors have not been helpful in this direction. In particular, we have noted with disappointment and grave concern that our bureau de change operators have abandoned the original objective of their establishment, which was to serve retail end users who need $5,000 or less. Instead, they have become wholesale dealers and illegally in foreign exchange to the tune of millions of dollars per transaction. Despite the fact that Nigeria is the only country in the world today where a central bank sells dollar directly to bureau de change operators. Operators in the Nigeria's bureau de change segment have not reciprocated the bank gesture to help maintain price stability in that market. Whereas the bank has an understanding with bureau de change operators that they make a small margin from sale of the US dollar allocated to them per week, they have reneged and become somewhat greedy, recalcitrant, with abnormally high profits from these sales, while ordinary Nigerians have been left to feel the pain. Behavior, it is not surprising that since the CBN began to sell foreign exchange to bureau de change, the number of operators has risen from a mere 74 in 2005 to over 2,700 in 2016 and almost 5,500 BDCs as at today. In addition, the Central Bank of Nigeria constantly receives nothing less than 500 new applications for BDC licenses every month. And we therefore begin to wonder what is in this business that everybody must be in it. Rather than help to achieve the laudable objectives for which they were licensed, the bank has noted the following unintended and unfortunate outcomes. 1. Avalanche of rent-seeking operators operators only interested in widening margins and profits from the foreign exchange market, regardless of prevailing rates in the market. 2. Gradual dollarization of the Nigerian economy with attendant adverse consequences on the conduct of monetary policy and subtle subversion of the cashless policy initiative of the Central Bank of Nigeria. 3. Prevailing ownership of several bureau de change by the same promoters in order to illegally procure foreign exchange multiple times from the central bank. 4. Numerous and repeated financing of unauthorized transactions with foreign exchange procured from the Central Bank of Nigeria. 5. Indeed, we have evidence that several international organizations, embassies, regrettably, and development finance institutions, I repeat, regrettably, operating in the country, patronize BDCs through illegal Forex dealers to fund their local operations in further and flagrant contravention of our foreign exchange laws and regulations in Nigeria. Our examiners are currently looking at the books. We have reports that indict development finance institutions, embassies, international finance organizations who, instead of selling their foreign exchange into the recognized investors and exporters window, have resorted into operating with illegal forex dealers in flagrant contravention of our laws. And we will deal ruthlessly with the Nigerian banks who have acted as collaborators with these illegal forex dealers. We will deal with them ruthlessly because they have allowed their banking and payment system infrastructure to be used to facilitate this illegal dealing in foreign exchange. As for those foreign organizations involved, we will report them to their regulators. We will write to those organizations seeking their understanding and that they must desist. If they seek to operate in Nigeria, they must go through the right channels through which they must procure either foreign exchange or procure naira for their domestic operations. For avoidance of doubt, such transactions should have been done at the transparent investors and exporters window. These unintended outcomes have placed an unsustainable and enormous financial burden on the CBN and our limited foreign exchange. The CBN sells $20,000 to over a week. This amount translates to about $110 million per week and about $5.72 billion per year. This is a scarce resource, and Nigeria's central bank, the Nigerian government, cannot continue to allow this unwholesome practice to continue in Nigeria. This is a huge hemorrhage on our scarce foreign exchange reserves and cannot continue, especially because we are also concerned that bureau de change have become a conduit for illicit financial flows. Indeed, the facts abound that BDCs have turned themselves into agents that facilitate graft and corrupt activities of people who seek to conduct illicit funds flow and money laundering in Nigeria, and we will go after all of them. Throughout this meeting of the Monetary Policy Committee, we extensively debated these matters and independently with each member of the committee exhibiting accurate and deep understanding of the issues at stake. After these exhaustive and comprehensive deliberations, the management of the central bank will, with the full support of the committee, reach the following decisions which will take immediate effect. A. First, the central bank will henceforth discontinue the sale of foreign exchange to bureau de change operators. B. The bank will no longer process or issue new licenses for BDC operations in the country. This stoppage extends to all licenses being currently processed, regardless of the stage of that processing. C. The bank would henceforth channel a significant portion of weekly allocations currently meant for BDCs to commercial banks to meet legitimate FX demand for ordinary Nigerians and businesses, whether for small-scale imports, medical bills, educational expenditure, personal and business travels, or any other legitimate needs as prescribed by the CBN's foreign exchange manual. D. All commercial banks in the country will, with immediate effect, create a dedicated teller point in designated branches for sale and disbursement of foreign exchange to customers who desire FX for legitimate purposes. For emphasis, the public should note that once a customer provides the basic documentation to purchase foreign exchange, all banks must immediately, either on demand or within a stipulated time frame, sell foreign exchange to the customer. Any customer who does not receive foreign exchange along these lines must report this to their bank, and where they are unsatisfied with resolution, they are required, indeed they must, contact the CBN on our toll-free line number 070-02255-226. I repeat, 070-02255-226, or email cpd@cbn.gov.ng. Repeat, email cpd@cbn.gov.ng to lodge a complaint with details of the bank's transaction. In closing, let me note, very importantly, that these measures are not intended to be punitive on anyone or any group. Rather, it is meant to ensure that the CBN is better able to carry out its mandate in an effective and efficient manner, which guarantees preservation of our scarce commonwealth and that our hard-earned financial system stability remains intact to and for the benefit of Nigeria and all Nigerians. I thank you for your attention.